here with Business Insider's finance editor, Matt Turner, who just came back from his wedding celebration.
I did, thank you.
Congratulations.
Thank you very much.
And you also spent this week, you went to the UBS CIO Global Forum for us.
Yes, that's right.
And you spoke to a bunch of CIOs.
Yes.
Thank you. This is a great clip that we have. But also, what else did you learn from them? What other interesting takeaways were there?
So I spoke to about 8 CIOs, big investors from one individual who managed or oversaw $2 trillion to smaller managers, but again, influential voices in the markets. And I think the takeaway, although they all had slightly different views, was that the stock market, it's fairly valued, it's maybe a little bit richly valued, but not too much. So everyone felt like there was a certain amount of overconfidence maybe, that the valuations were a little bit stretched, but they didn't see any causes for alarm anytime soon.
So everybody still feels like, yeah, valuations are high, but no necessary catalyst or cause for a correction?
Exactly, no cause for correction. Harder to find opportunities maybe, so you have to work a little bit harder to find those segments of the market where there's still money to be made. But there wasn't anyone that I met or spoke to that said, you know, we're going to see a 5 or 10% drop anytime soon. Still just edging higher, grinding higher.
Which is interesting, which leads us right into our Fidelity Insight today. Fidelity's Director of Global Asset Allocation Research, Lisa Emsbo-Mattingly, says that since 1920s, on average, the U.S. stock market has had about 3 5% corrections a year, 1 10% correction a year, and a 20% correction every 3 years. And if you look at a chart that we have, you can see there's a 20% correction in red, but the rest are 5% corrections in blue. And the most recent one was about a year and a half ago. So there is some concern that we might be overdue for a correction, and Goldman seems to think the same thing. Goldman put out a note, and their bear market risk indicator says there's a 67% chance of a crash, and they're also pointing to the same thing. It's been a year and a half since we've had a 5% correction. So, and as Emsbo-Mattingly also points out that a lot of portfolios, investors have gotten a lot more into stocks recently, where half of their portfolio was in stocks in 2009, two-thirds of their portfolio are in stocks at the end of 2016, which is right where it was before the financial crash. And she's saying you should readjust if that's not where you want to be in case something happens. So one of the things I'm wondering is, do you think that most of that gain in the allocation is from just the increase in the stock prices, or are people actually getting in as the stock market's going up?
So one of the interesting conversations I had was actually with a behavioral finance specialist, and they were talking about this trend for when markets are rich for people to buy and when markets are low for people to sell, which is obviously the opposite of what you should be doing. I think there is a certain amount of, as markets get higher, keep on grinding higher, there's no obvious catalyst for there being a sell-off. People feel like they have to be involved, right? They feel like they're missing out. They see that other people are having opportunities and gains, and they're not. And so that starts to kind of carry a weight for those individuals. So I think you are seeing people put a little bit more money into the stock market. And part of it is also, as I said, a lack of a catalyst for a sell-off, right? Whenever we see, I don't know, North Korea or geopolitical risk, markets move a little but not too much. And so when you see that, you can kind of feel a little bit more secure that if markets are able to shrug that off, then they're going to be able to shrug most things off.